welcome to today's session, entitled Invoices Don't Pay Themselves, or Do They? My name's Pranav Sood, I'm the VP of Small Business at GoCardless, and to answer that question, I'm joined by my colleague Simak, our Director of Product Marketing. Now, I'm pretty sure everybody on this call has at some point in their lives experienced the pain of being paid late. They've felt the impact, whether on their cash flow, on the number of hours they need to spend chasing up payments that are late, on the relationships that they've got with their customers after those awkward conversations about why the money still hasn't been transferred yet, or perhaps even on themselves, their mental health, and their friends and family. We're here today to tell you it doesn't need to be this way. Over the course of the next half an hour or so, we're going to talk to you about how you can transform your cash flow and how, partnering with GoCardless, you can get your invoices to be paid automatically, saving you time and money and freeing you up to focus on the things that you do best. So, without any further ado, Simak, late payments, how bad are they?
I mean, pretty bad. You only have to look at some of the top level numbers to see that, right? So you've got 30% of payments are actually paid late, which causes huge problems. You've then got businesses on average spending 1.5 hours per day chasing late payments, 50% of which is spent outside of typical work hours, which adds to huge mental health stresses and so on. I think very roughly businesses in the UK spend £7 billion a year, or close to £7 billion a year, just trying to get the money that they're owed. And something like 50,000 businesses every year go out of business because of late payments. So yeah, I think late payments is a huge problem.
And why is it such a huge problem, Simak? So how do people get paid today?
It comes down to the fact that people actually collect their payments in ways that aren't optimized for what they're using them for, right? So if we think about the main ways that people take payments today or collect their payments today, broadly speaking, you've kind of got three main buckets of payment methods, right? So number one, you've got what I like to think of as push-based payments. And by push, what I mean is that the payer, your customer, actually sends you the money. And these typically take the form of bank transfers or check, right? So what typically happens is a business will say, okay, I've done some services for you this month. I'm going to issue an invoice. That invoice is for, let's say, £1,000. That invoice is going to have an account number and sort code written on the bottom. And their business will say to its customer, can you please pay £1,000? And that business, the customer will then, at some point, when on receipt of that invoice, actually, send a bank transfer worth £1,000, or potentially, write out a check and post it to them. And that comes with a bunch of problems, which I'm sure we'll get into. But really, really broadly, you've got first of all, your customer, being human, gets distracted, has many different priorities. Maybe it's not absolutely top of their agenda to pay you at the perfect time or pay you on time. That's kind of number one. And that's where you see debtor days or day sales outstanding being really, really high, on average 30 plus days, but in some cases 60, 70, 80, 90 days, right? Which is just money that's not in your business, which is contributing to this late payments problem, contributing to 50,000 businesses going out of business every year because of late payments. It's not just the late payment side though. It also, these kind of push-based payments where the payer pushes the money to your bank account via a bank transfer, let's say, tends to be quite a high load from an administrative perspective. Quite a lot of time involved for the payer, your customer, and quite a lot of time involved for you to actually reconcile that payment and actually make sure that you've been paid the right amount from the right customer and so on. So that's kind of one area that causes a lot of these problems. The second bucket is payments via credit cards or corporate cards or digital wallets. And they tend to either be, very similar in the sense that, you send out an invoice and you say, make a payment, click on this link to make a credit card payment, and we'll get the money when you make that payment. These are again kind of quite push-based in the sense that you're still waiting on the customer to push the funds to you and to actually take an action with their credit card or with their digital wallet. They tend to be actually quite expensive as well. So it costs a lot of money to process these types of payments. You can actually set these up to be what I like to think of as pull-based, as in you take the credit card or you take the digital wallet, you store it on your side as the merchant, and then you just charge it every month when you need it. And so you're pulling the funds from your customer. That obviously comes with some benefits in the sense that you're in a bit more control, but the failure rates on these types of payments are quite high. It's quite likely that a credit card will have expired, and in fact something like 8 to 10% credit card payments fail for that reason every single month when it comes to recurring payments. And then it kind of got this final bucket, which I like to think of as being traditional direct debit, which I'm sure many people on this who can see this will pay their electricity bills or pay their kind of mobile phone bills through direct debit. It's an option that's available to many types of businesses to collect ongoing payments. Typically, you have to work with a bank. There's quite a high barrier to entry. It's definitely difficult to work with a bank to integrate into your modern cloud environment. Let's say to integrate into QuickBooks. And there's quite a lot of geographic fragmentation, which makes it super difficult to work with. So those are three main buckets, and as you can see, they've all got quite distinct problems, which cause a lot of these issues around payments being late, payments costing a lot to chase, and businesses going out of business as a result.
So let's just summarize again, Samak. Why does this happen? What's wrong with the way that people get paid today?
Yeah, so the way that I kind of think about it in summary is that people tend to defer or default to a push-based payment mechanism, which is ultimately dependent on the end customer sending you the funds, which is time-consuming for the end customer, B, time-consuming for you to then process, and C, it's so far outside of your control as the person who's delivered the services that you're kind of left in the dark as to what's happening and how to kind of drive things forward.
Makes sense. So push-based payment mechanisms not ideal for invoicing relationships is the short takeaway that I take from your assessment.
Yes, I think so. And I think the interesting thing is a lot of people default to these push-based payment mechanisms because they work for maybe a one-off project or a one-off payment that's happened in the past. But as more and more businesses have moved to relationships which are recurring, right? So it might be an ongoing monthly payment that's required for services rendered, or regular deployment of services over the course of the year. Something that works for that one-off payment doesn't necessarily work and actually starts to stack up debt in some way over the course of the year if you're trying to do it again and again and again.
So we've talked a bit about the problems caused by late payments. We've talked a bit about the different types of payment methods out there and some of the reasons why they're contributing to the challenges that businesses face with late payments and payments in general. But I think it's worth us stepping back a bit, because it feels to me like the root cause of a lot of the problems that we've already highlighted is that people are matching the wrong type of payment method to their business model. So perhaps we just pause there and talk a little bit about business models before we talk about payment methods. And I wonder, Samak, can you just guide us a bit? How should business owners, how should accountants be thinking about business models?
Yeah, it's a really important question because, as you said, you've got to match your payment method to the model that you're working on, right? So I think that the broad first sweep is really, are you operating a recurring revenue business, or are you running a transactional business? And they are quite different, right? So, and yes, there's sometimes a little bit of overlap, but really, if you're running a very transactional type of business, where a user or a customer comes and buys one service off you, you may not know who they are, you're unlikely to know if they come back. It's very transactional in its nature. It tends to be kind of very much almost an e-commerce play, if you see what I mean. And with those types of business models, They come with their own problems. They come with their own concerns, their own things you need to think about. But I don't think that that's the business model that, at least from my understanding, the majority of people who are watching this will be thinking about that type of business model. I think you've got this second area, which is this recurring revenue relationship, which I think we're all very involved with. Most of us on this call are very involved with today, and that's where a lot of this mismatch between payment methods can come, and a lot of pain comes as a result.
And it's important on the recurring piece to basically really clarify that recurring doesn't mean that you're charging the same amount on the same day every month, right? Because a lot of people, when they think about recurring, they think, oh yeah, my gym subscription is recurring. I pay 20 quid on the 28th of the month and it recurs again the following month on the same day. But the way to really think about recurring is about when you think about who your customers are, right? So maybe just expand a bit on that point, would you, Simak?
Yeah, so and it's a great point, because when you hear recurring, you think same date, same month, same amount. Where in actual fact, there are a few different types of recurring revenue business models. We kind of broadly think of them in three areas. The first one is kind of what we think of as invoicing. And this is where, to your point, Pranav, your customer is buying a service off you, and the degrees to which they buy that service, or the volume of that service that they buy on a regular basis, can vary depending on how much they want to consume of your service or not. And so you might 1 month issue an invoice for £1,000 because that's what they've used of your service. Next month might be £0 because they haven't used anything, and the following month might be £7,000 because they happen to have consumed an awful lot during that period of time. So it can go up and down, really depending on how much they've used. So a classical example might be, let's say you're a law firm or accounting practice, and you're charging by the hour, and your customer might use a varying amount during the month, and therefore the invoice that you issue at the end of that period of time will be slightly bigger or slightly smaller. But it's not just it might not just be accountants and lawyers who have this type of business. This exists right up to major global companies like Amazon with their AWS service. It's effectively billed based on how much you use in any given month, and so the invoice that you issued at the end of the month is defined by how much you use. That's kind of what we call invoicing. Then we have kind of more classical subscriptions, which is kind of what you were referring to, I think, at the start, Pranav, which is you'll bill the same amount on the same date of the period. It might be a gym membership, or it might be a subscription to a SaaS platform that you use, and maybe you're spending £100 a month on it, and it comes out of your account every every month on the first of the month. And it doesn't really vary. And then the third kind of recurring revenue business model that we see is this installment, this idea of installments, where you're paying a fixed amount over a fixed period of time on a regular basis. So let's say it might be for a project that you're doing for a company, and you're paying in three installments. You pay up front, and then you pay 2 subsequent bills. Or it could be paying off a loan, let's say, to repurpose and redesign an office, and you borrowed £50,000 and you're paying it off in installments over the course of a year or something like that.
So the first bit of the question of how do I match my business model to my payments method is about figuring out your business model. And really, if I'm listening to you correctly, what you're saying is the key question to ask yourself is, do I have a transactional or one-off type business model, or do I have a recurring business model? And when you think of recurring, don't think of gyms and Netflix. Think of, do I have the same set of customers whom I'm invoicing or collecting subscriptions from or collecting installments from month after month? And if that's the case, and I would imagine for many of the people listening to this it is, because typically speaking, the accountants I know are not going out there and acquiring a whole new book of customers every month or every quarter, then you need to think about yourselves as a recurring revenue business. And that comes with a whole set of different requirements and needs from a payments point of view. So let's pivot to that second part of the question then, which is how do I pick the right payment method? I wonder, Simak, if you could give us some of the dimensions that people should be thinking about when they are evaluating the different payments that are out there for them to offer to their customers.
Yeah. So we've done some work on this at GoCardless, where we're trying to figure out a way to make it really easy for businesses of any size in any location to figure out, okay, what are the things that I need to really focus on and concentrate on to get right. Certainly for smaller businesses, certainly for smaller businesses who collect, let's say, invoices on a regular basis, we typically see 4 dimensions being really, really important to the way that they think about their payments. And by optimizing across these dimensions, they can actually generate pretty outsized effects just by really laser focusing on these things. And by focusing on these things, they can figure out what's the best payment method to optimize for these things and generate the effects that they need. So, I mean, just to kind of set us up, and I'm sure we'll dig into them, those 4 are payer preference. So how do your payers actually like to pay? Secondly, it's cost. So what is the total cost of operating a payment method? Thirdly, it's visibility. So how much and how quickly do you get information about a particular payment? And then fourthly, it's cash flow. So how quickly do you get money into your bank account once an invoice becomes a receivable?
So payer preference, cost, visibility, cash flow. Those are the 4 things that people need to be thinking about when they're picking the right payment method to use for their business. So let's just apply those 4 tests to the different types of payments that you introduced earlier. I wonder, maybe we start with bank transfers, because I imagine that's how many of the people on this call are getting paid today. How do bank transfers score against those 4 criteria?
It's really, really interesting. So they score quite poorly on most of those criteria if you take it in the aggregate. So if you look at something like cost, on the face of it, when you think about upfront, what is the cost of a bank transfer, your head might immediately go, well, it's nothing, it's free, right? There is no transactional cost involved in necessarily making or receiving a bank transfer over and above what your bank might charge you to receive some money into your bank account. However, that's not the only element of cost. Cost is actually made up of quite a few areas, and so when you think about cost, it's total cost. So that might be the administrative time involved in actually reconciling your payments. So finding out if a payment has been made. If somebody send you a bank transfer, it's effectively offline, right? You've got no real way of tracking that payment. You don't know when it's made. But if it is made, somebody just needs to log into your bank account, check to say, yes, we've received £1,000. Who owes us £1,000? Okay, it's got this reference number on it. I'm going to go and check what this reference number aligns to that customer. Imagine having to do that, hour after hour after hour, day after day after day. All of that adds up in terms of either direct costs in the sense that you're having to employ somebody to do that, or relatively kind of an opportunity cost in the sense that this is time that you might be better spending actually generating revenue or doing the thing that you love, right? So from a cost perspective, bank transfers don't really stack up overall, and we know that roughly about 2/3 of all total kind of processing costs are actually associated with the human costs, not with the transactional element. That's kind of number one when it comes to cost. When you think about visibility, so how much information do you know about a particular payment? Do you know when it's been paid, when it hasn't been paid? Again, visibility, from a visibility perspective, bank transfers fall down pretty hard in the sense that you don't really have a clue whether or not something has been paid until you've actually reconciled it, right? It's kind of relatively unlinked, and so if a customer is just making a payment to you, you don't know that it's gone. If they haven't made it to you, there's nothing that says this is. There's no automated way of saying this has been paid or this has failed because of a particular reason. You've got almost no visibility on the status of the payment, which again causes a huge amount of stress, but also causes you to employ manual tactics to figure that out, like calling the customer. When it comes to cash flow, again, you might say, it's relatively quick for money to be transferred from account A to account B, which is my account, let's say, or your account as a business. That's true. In the UK, if that goes over faster payments, that can be relatively quick. But the truth is, invoices that are paid by bank transfer tend to be the ones that are paid late, right? I mean, you start to see day sales outstanding of 30 plus days, and in many cases 50, 60, 70, 80, 90 days. And that happens, like I said previously, because humans being humans get distracted and just don't pay on time. And that's because it's a push-based payment mechanism, which leads to poorer cash flow for you as a business. So on those three dimensions alone, it stacks up pretty poorly. The only one where bank transfer do tend to stack up quite nicely is in this idea of payer preferences. How do businesses actually like to pay? And there is quite a common thought amongst businesses that it's better for you as a business to actually have to make a manual bank transfer when you pay a bill, because then you've got control over when you pay that bill and how you pay that bill. And I think, and that's why it's often perceived as being quite preferential to pay invoices by bank transfer. However, one of the things that we certainly know by looking at preference is that, first of all, yes, there is a preference to pay invoices by bank transfers. But what's really interesting is, and this is on to the second point of how static is that you can really quite meaningfully influence the way that people prefer to pay. So they may have an upfront stated preference to pay, let's say, by a bank transfer, but if you actually ask those same customers, okay, so you prefer to pay by bank transfer, but would you also be okay to pay by direct debit? Here are the reasons. Here's how you can do it, and here's why it might be a good thing. Roughly 70%, 71%, I think, of people actually are perfectly able and perfectly willing to pay by direct debit versus a bank transfer if you give them the choice. And typically, when we ask those kind of questions, okay, well, why do you prefer to pay this way over that way? Certainly, we've done a lot of research on direct debit. And what we find is that end payers prefer to pay by direct debit for three main reasons, really. The first is that, frankly, it's just the way that they were asked to pay, and we tell people not to not to kind of overthink this. Customers and payers happy to pay in different ways depending on your recommendation. Secondly, that it gives them a huge amount of peace of mind, and I'm sure we can dig into what that peace of mind is. And then thirdly, that it actually saves them time and money themselves on their own side, as compared to, let's say, actually logging into their bank accounts and making a payment manually.
Fantastic. So we're basically saying that people need to be thinking about four key dimensions. They need to think about the cost, the visibility, the cash flow, and then the preference associated with the payment methods that they're choosing. And I think, Simak, you've laid out really nicely there how bank transfers or credit transfers fall down on a number of those areas. I wonder, because you alluded to a couple of other payment methods in that answer as well, I wonder if we could also just pull out the contrasts for, firstly credit cards, and then secondly for direct debit. We probably don't need to go through every single one of those dimensions, but maybe just the key headlines that people need to be aware of when they're thinking about those dimensions.
Yeah, sure. So credit cards, pretty widely known, pretty well known. I think typically it's everyone's kind of first port of call as to, I need to set up a way to take payments. People often think credit cards, and so when you look at them against those dimensions, the big issue with credit cards is that they typically are relatively expensive from a transaction fee perspective. So if you think about the cost involved from a top line cost, typically you're looking at somewhere between 1% and 3% to actually process a credit card payment, which certainly for higher value transactions all of a sudden stacks up to be relatively high, quite a lot of money. And so that's kind of the first thing to think about is what are the transaction fees involved. But even as we broaden out costs to be a little bit broader, I'd certainly look at what are the costs to actually successfully collect credit card payments. And so credit cards suffer quite a lot from what I call kind of high payment failure rates or low payment success rates, particularly for recurring payments. So typically, if you have a credit card and you want to charge it, let's say every single month, because you're charging it to collect an invoice every single month, that will be successful about 90% of the time, and about 10% of the time it will fail. And the reason it fails is because credit cards expire, right? They aren't really built for recurring payments. And so as a result, when those payments do fail, much like when somebody doesn't pay an invoice by a bank transfer, you've got to figure out what to do next. And that involves calling the customer, again, trying to understand what happened and trying to kind of recover and recollect the payment, which all adds to the cost of collecting. And that's an example of where with credit card payments, you're really looking at quite a lot of cost involved in both the top level, but also in the broader sense as well.
And so then maybe just bringing on the third answer there, which is the direct debit piece. Why do we think that direct debit actually performs pretty well on those 4 dimensions that you've laid out?
So basically it's because if you think about what direct debit's for, it's built for recurring payments. It's built to enable payments to be collected on a regular basis from your customers. And so if you think about what these kind of dimensions are, they're effectively enabling you to successfully collect recurring payments, right? So if you think about the cost, because you're collecting directly from the bank account, and there aren't global kind of networks in the way, like a Visa or a MasterCard, for example, the value chain is a little shorter, so the top line costs are a little less. So you can you're saving some money there. Not only that, but payments via direct debit tend to be more successful. I kind of gave that 90% payment success rate for credit cards, which is an approximate number. For direct debit, it tends to be around the 97%. So even there, you've kind of got a significant improvement in just the number of edge cases, the number of failures that you need to deal with and figure out what to do with on an ongoing basis, which can significantly remove costs from your business. Likewise, on a visibility perspective, you can really nicely line up reasons why things have gone wrong. So payments do go wrong, and if they do go wrong for direct debit, you tend to get quite detailed reason codes. And with GoCardless, for example, that can be pretty tightly integrated into your platform, so kind of be perfectly pushed into QuickBooks, so you can see these are the payments that have been successfully collected, these are the payments that haven't been, and here's why those payments haven't been successfully collected, so you can address them appropriately. And the other thing is your payments can be automatically reconciled as well, which saves you a huge amount of your administrative time. You no longer have to manually go and log into a bank account and say, okay, what's this reference number, who's paid this, and who were they. That's all done automatically. And then from a cash flow perspective, you're really in control of pulling those funds from your customer's bank account, so that rather than saying, hey, can you just make that transfer when you get a chance, what you're saying is on day 30, I'm going to collect from your bank account. It's going to happen automatically. And 97% of the time that happens automatically on that date. And then you can kind of schedule retries to happen when you need them to. Then that's kind of how I'd bring that all together, right? So you've kind of got the key points of pull-based, bank-based, and automated, and then you layer in kind of preference, cost, visibility, cash flow into that, and you can kind of stack that up and see that direct debit gives you superior metrics across a range of things. And we can prove this out as well at GoCardless, where we've done a number of kind of third-party studies as well as our own studies, where companies who move to GoCardless typically see about a 47% improvement in their time to get paid, right? We typically see that customers spend about 90% less time actually managing their payments, and roughly save about 56% on the total cost of operating their payment stack. So even across those three there, you've got immediate kind of benefits.
So we're saying basically direct debit, it's highly automated. It gives you visibility and predictability about when you're going to get paid. It gives you a pretty low cost way of collecting payments, both in terms of the transactional cost, but I think more importantly in terms of the whole cost of collecting payments, which includes the admin and the time that goes into that. And with GoCardless for QuickBooks, you can access all of that in a fully integrated way. So it's something that's built in natively into the QuickBooks world, so you don't need to do anything from a technical point of view to integrate with GoCardless. It's something that you can access out of the box and as soon as you're ready to collect payments. I think we've covered a lot of ground there, Simak. We've talked, at first about why late payments, happen and how bad the problem is. We've talked then about how people should think about their business model, whether it's transactional or whether it's recurring. We've then touched on the dimensions, the 3 or 4 dimensions that people should consider as they're, picking out the right payment method for them. The points being visibility, cash flow, cost, preference. Those 4 big points that really help to make high quality decisions about the right payment methods to use for the business models that people have got. I wonder if we wrap all of that together into a little case study maybe, because I think we can probably make it sound a bit more real if we apply it to a real set of business circumstances that I'm sure many people will recognize. So help me paint a picture, Simak. Give us a business and let's talk through the way that they collect today, some of the pain points that they have, and maybe how we think they could improve their collections.
Yeah, I mean, so let's make a business now, but Acme Corp is its name, and I'd say that a typical Acme Corp typically is an invoicing business, right? So it issues invoices on a monthly basis to its customers of varying sizes and varying degrees. Those invoices are issued on the third or fourth of the month, and typically they have 30-day payment terms. So they're expecting those invoices basically to be paid by the end of the month. What's typically happening is that they say pay by bank transfer, so they put in their account number and sort code on the invoices, and basically from that, what I would think was just like a hope and a prayer that their invoices will be paid. And what's typically happening with this business is that instead of being paid on time every time, they're being paid much later, right? So as you said, 30% of payment of invoices are late. Their average kind of day sales outstanding or debtor days is probably in the 35, 40, 45 days region, maybe even higher in some cases. And each invoice is worth, let's say in the thousands of pounds. So actually at any point in time, you're probably looking at tens of thousands of pounds which are outstanding outside of their business in receivables that should be inside of their business right now. So you've got likely facing cash flow issues. They're spending a lot of time in terms of trying to chase those payments. Typically 1.5 hours a day are being spent on the phone trying to chase payments, trying to chase money that's owed. And a lot of that time and pain is put onto the owner of the business, which causes a huge amount of stress in their life. They're likely spending hours outside of their typical workday trying to manage all of this.
So it's an invoicing business. They're probably getting paid via credit transfers. They're probably waiting far too long to get paid and spending far too much time chasing up payments and having those difficult conversations with their customers around why they haven't got the money that they're owed for the services that they've provided. Simak, you mentioned a fictional company, Acme Corp, but there are thousands of businesses, probably tens of thousands of businesses every day who experience this exact set of circumstances. Just to pick a couple from the kind of case studies that I know, I remember Ross and Steve at Acumen Accounting, who scaled up their practice really quickly, but ended up finding a situation where they were waiting up to 90 days to get paid. Or if I think of another one, it's Jessica Zune at Zune Digital. They're a sort of digital agency who is typically seeing 60 to 90-day payment terms for invoices. And maybe one more, Lisa at Boogle's Bookkeeping. Similarly, family-owned business, scaling up, growing, and yet struggling to make sure that the working capital is in order because their customers are taking far too long to do those credit transfers and do those push-based payments to kind of pay for the services that they'd consumed. So we've got a fictional example, Acme. We've got a few real examples there with Zune, with Acumen, and with Boogle's Bookkeeping. Why should businesses use GoCardless? Why did the three that I just mentioned use GoCardless?
I think it comes down to solving those real problems and those real dimensions, and being able to do it in the easiest way possible, right? So, you want a payment method that's pull based. GoCardless offers you a really easy way to set up a pull based payment mechanism where you can just draw funds directly from the bank account of your customers on the date and timing of your preference, basically. Number one, it's pull based. Number two, it's directly from the bank account. And because it's directly from the bank account, you're able to manage things like success rates in just a much more improved way. Something like 97% of payments are paid at the first attempt. And then thirdly, which I think is probably most important, is that it's entirely automated and integrated into QuickBooks, right? So there is very limited involvement from the point at which the kind of invoice is issued. You don't have to do a huge amount of integration work or setup work. It's kind of plug and play. These businesses can just kind of use us directly within QuickBooks, issue the invoices. At that point, on the date that the money is owed, and the date that payment is due, GoCardless will just collect those funds, deposit them into your bank account, and then within QuickBooks, the invoice will be marked as paid. And if it's not paid, let's say that the invoice that the payer, the customer had insufficient funds, then it's just clearly labelled as unpaid. Here is the reason why, and here are the actions you can take off the back of that.
Yeah. So with GoCardless, people are selecting a payment mechanism that has been designed for recurring payments, and one which is, as you mentioned, pre-integrated with QuickBooks, so there's no technical work required, but which offers them also a cost-effective, a predictable, and a really slickly designed way to collect payment for recurring invoices, recurring subscriptions, recurring installments, really, really easily without any additional technical work or any complexity involved whatsoever. So we've talked a lot about the today and all the reasons why we believe that right now GoCardless is the best way to collect recurring payments out there in the market. But our product isn't staying static. So I wonder, Simak, if you can talk a little bit about the future. What does the future hold for GoCardless and the offering that we have?
I think there's two main areas of development that we're looking at that I think will add significant value to our customers and everyone in the market, really. I think number one is how do we leverage all of the intelligence that we have about payment processing to do really specific things. So we process, in a macro sense, we process $20 billion plus of payments every year. We process hundreds of millions of transactions for tens of millions of payers across tens of thousands of businesses across 30 plus countries, 8 different direct debit schemes around the world. How do we leverage all of that intelligence to make certain predictions and bring those predictions down to the level of the individual merchant and the individual payer? So a really good example of using all of that intelligence is a product that we launched last year. That product's called Success Plus. And what Success Plus does, it's a product that's designed to help businesses manage and reduce payment failures. As I mentioned, payment failures through GoCardless, typically about 3% of payments fail, which is actually really strong anyway. But we think we can get that down even further. And so we launched Success Plus to help do that. And so what Success Plus does is if a payment does fail, instead of businesses typically retrying on a fixed schedule or retrying it as soon as possible, it predicts the best time to retry a specific payment for a specific payer. So it might say Pranav's payment has failed. The best time to retry Pranav's payment is on the 18th of February, but Simak's payment has failed. The best time to retry Simak's payment is actually on the 28th of February. And in doing so, you get a much more customer-centric way of approaching failed payments than you do just kind of doing it in a random or as soon as possible way. And so that's driven really, really nice outcomes for about 10,000 of our customers who use that today. And in the future, what we'll do is looking at number one, how do we improve that product by applying the intelligence that we have in an even more intelligent way. But secondly, what are the other products and services that we can deploy with that same sorts of intelligence? You can pretty easily envision a world where we can use that intelligence to predict, let's say, if a payer is actually a fraudulent payer, and we'll actually be releasing an anti-fraud product based on that later on in 2021. So that's kind of one big area. The second big area is leveraging a lot of the opportunities that have been opened up by open banking. So if you're not familiar with open banking, really quick and heavily simplified view is that banks are opening up access to payers' bank accounts so that you can do interesting things with the payer's permission that broadly involve looking into the account to identify who they are, and let's say figuring out what their address is, or do they actually own the account that they say they own, with their permission, of course. And then secondly, actually triggering or initiating payments from within the bank account, which opens up a whole range of possibilities that we've been playing with for a year or two now. And we've got some really nice features that we're going to be launching in the next couple of months, designed specifically around verifying ownership of a bank account. So you sign up for a service, you provide a business with your bank details as a payer. We can now verify that you actually own those bank details. And then secondly, initiating payments from within your bank account and then automatically, let's say, delivering that experience within a recurring payment experience as well. So a really easy example might be initiating an upfront payment at the start of a service, let's say at the start of an installment plan, or for the very first payment in a relationship, and then combining that with direct debit to make all subsequent payments. And I think what's really interesting is, if you think about those different aspects, the intelligence, open banking, and our core platform, on their own, each one of them is quite powerful, but the combination of all three together is super powerful and solves for an increasingly wider set of recurring payments use cases.
I'm conscious we've covered a heck of a lot of ground in the session today, and I want to bring it all the way back to the question that we started by asking ourselves, which is, invoices don't pay themselves, or do they? Today, Simak, we've talked about the pain that late payments causes to small businesses around the UK. The costs, the emotional challenges, the admin, the time, all of that stuff. We've also talked about the reasons why those problems occur, and I think you've pointed out those 3 or 4 dimensions that people need to be thinking about in that context, and when they're evaluating the different methods of payment that are out there in the market, whether that be bank transfers, whether it be credit cards, or whether it be something else like direct debit. And I think what we've shown is that the first and most important question to ask yourself as a business owner is, what is my business model? And is my business model transactional? So is it truly one-off, or is it recurring? And when we say recurring, we mean, are you invoicing, are you collecting from the same set of customers time after time? And that doesn't mean you're collecting the same amount from them every month. It doesn't mean that you're collecting on the same day every month, but it does mean that you've got those lasting, trusted relationships with customers who you want to find a way to collect from, which gives you the best scores on cost, which gives you the best scores on visibility, which gives you the best scores on cash flow, and which gives you the best scores on customer preference. And bringing all of that together, we've shown you that GoCardless is the right method for you to choose. It's the only payment method out there that's been designed specifically with recurring payments in mind. And it offers you the opportunity to collect recurring payments in a cost-effective way, in a way that gives you that visibility and predictability of your cash flow, and in a way which importantly integrates seamlessly with your QuickBooks product, and which allows you to access all of the features and functionality and benefits of GoCardless from within the QuickBooks environment, without you having to engage in technical or engineering work in order to build that. So it's out of the box, it's ready to go, and it's a payments product which is going to solve your late payments problems. And we've also, Simak, I think, finally pointed to the future. So we already believe, and I think thousands of businesses out there would also believe it with us, that GoCardless is the best way to collect recurring payments, but it's only going to get better. And when we think about payment intelligence, when we think about open banking, we can see loads of really tangible ways that businesses in the UK and around the world, frankly, are going to benefit from the accumulated wisdom and processing and experience that GoCardless brings to the table. So thank you very much, firstly, Simak, for your time. Thank you to everyone for listening. We hope that you've enjoyed and found this session valuable. Please do answer the questions that are going to pop up on your screen shortly. We'd really appreciate the feedback from the survey. And if you're interested in finding out more about GoCardless, please head to our profile page where you can learn a bit more about the things that we've talked about today and also explore ways to sign up. Thanks again, and have a great day.